Good day, everyone. Welcome to Silverdale Quarterly Global Investors Call for Silverdale Bond Fund Q2 2021. Can't imagine that we are already halfway through 2021. With countries speeding up their vaccination drives, we do hope we can see normalcy starting next month onwards. Most economies are now moving towards reality, which is that we need to learn to live with coronavirus, as we have learned to live with influenza, which in turn means the worst is behind us, and we look forward to a brighter future ahead. As to Silverdale Bond Fund, your fund has delivered 3.03% absolute return for H1 2021, as against Bloomberg Barclays EM Corp quasi-sovereign 1 to 3 years bond index return of 1.02%. Importantly, your fund has elevated leverage yield of 11.77% with a duration of just 1.85 years, which is a great news for further subscriptions. As we always maintain, carry is the king. And what can be better than to have a higher carry? I know a lot of you want to know what is expected in the second half of the year, particularly for your fund. So let me hand over to our CIO, Mr. Sanjay Goglani, to share our fund house views. Like always, we would like to make the session interactive. Hence, we would open the floor for Q&A after the presentation. In the interim, may I request you to keep your mics on mute. Kindly do put your queries on the chat or raise your hand. Thank you for your participation, and over to you, Sanjay.
Thank you, Mohini. It's always a pleasure and a privilege to address fellow stakeholders. Thank you indeed for all your support you've given to the fund. We are grateful to your contribution and committed to ensure that we can do our very best all the times. Today, I address you as the CIO of Silverdale Fund VCC, Singapore. As you know, your fund has moved from Cayman to Singapore, and we always strive to be ahead of the market. You've already seen what clamor we are seeing in the world in terms of global minimum taxation and the adjunct changes which we are seeing for the quote-unquote tax-friendly jurisdictions in terms of substance sector out there. In that regard, we have been much ahead of the market, and I'm sure all of us will reap huge benefits in the coming decade. On the note, let me take you to the presentation, and as usual, we would be taking questions after the presentation. In the interim, please feel free to write your queries in the chat or getting in touch with Mohini. So today we will be focusing in terms of our performance. We'll share with you what we did it, why we did it, and what we intend to do going forward. This is just a review and not any recommendation. Feel free to go through the firm documentations should you want to go more detail into it. Coming to the performance of Q2, the performance have been basically flat as compared to the previous quarter, where you had about 3% return. We have maintained our dividend of $2.10 per share for the quarter, which took your NAV to 116. The return which you're seeing of almost zero is principally because of the fact that there was a bond price depreciation by about 2 and consequent increase in yield by 2.18. Important thing to notice is that this delta which you wanted to see is basically reflected here in terms of elevated yield. So what you are seeing is that our current leverage portfolio YTM is 11.77 year with almost same duration of 1.8 years and marginally better quality portfolio of 77% IG. The consequence of the bond pricing, of course, is also that the portfolio yield itself has moved from 4 to 5.4%, which is a fantastic news for long-term investors, and I'll share about it later in my presentation. To give you quickly in terms of the H1, from the H1 perspective, we have given you 3% for the first half of the year as compared to minus 13% for the previous last year first half. But then, as you remember, this was the COVID period, so I won't pay too much focus on that. What as medium-term to long-term investor you should focus is in terms of our trailing returns. And from that point of view, we're still on the higher side at around 18% return for the trailing 12 months. Importantly, we have maintained the $8.40 dividend run rate per annum, even in the first 2 quarters of the current year. The 18% return which we talk about there was principally contributed by about 8.79% in terms of bond appreciation and a carry of 9.96%. And that's what I want to focus to highlight today again, that in terms of our current yield on leverage basis, we are much higher at 11.77%. In terms of the portfolio quality, the key difference is because there is a marginal tactical move from A-rated bonds to triple B-rated bonds, again to benefit from the price dislocation in the market and the opening of the economy. In terms of the portfolio duration, again, marginal adjustment, the 4% allocation from 0 to 1% duration has been moved to 1 to 2% duration and to 4 to 5 year duration. Again, a tactical move, no change or drift in strategy whatsoever. In terms of the diversification across geographies, we are in 108 securities across 23 countries, extremely well diversified portfolio. We have culled some of the positions where we could book profits, given in certain cases the yields are very tight, and in certain cases where we didn't have any meaningful holdings there. Therefore, you see the amount in terms of others, namely the countries where we have less than 1.5% exposure, coming down from 18% to 15%. Having said that, this 15% is still about 14 countries, and these include Russia, Kuwait, Hong Kong, Japan, UAE, Brazil, Australia, Canada, Saudi Arabia, Germany, Malaysia, Switzerland, South Africa, and Cambodia. Again, very well diversified. In terms of major allocations, no great change. We continue to like China, lean tactically slightly a percentage down, which is fine. India surprisingly continues to be 20%, which I mentioned to you again, is something which we are deeply cognizant of. Same in terms of exposure. Mexico marginally gone up out there, and Indonesia marginally down in terms of what we are seeing ground zero reality versus yields which you're getting for it. In summary, we are talking about having given return to you 7.32% compound return per annum for last almost 9 years, as compared to the index, which has given you about 4% return over this period. As you know, there would be some gyrations in the fund, but overall, we have always been able to grossly outperform the markets in our peer group and with relatively low volatility. When you invest into any fund, whether it's commodities, whether it's equities, whether it's debt, the single most important thing is consistency of returns. Right? What is the management ratio, TER ratios, everything is beautiful to talk about. But what matters to an investor from medium to long-term point of view is consistency of return. And I'm delighted to share that, as usual, our positive months are very high as compared to the industry at 69%. 69% of the months we have given you positive return, which shows immense consistency of the fund. As I always tell to people, the easiest way to look at our fund is that you can pick any random date over the 9-year history of this particular fund available to you. Hold the fund for 3 years, repeat the exercise 8 times, and you get 69% return. That's the proof of the pudding. From that point of view, again, it's a very consistent fund. So whenever you see something like today's position, where we see yields elevated, it typically points to a potential higher return than the average. Across this period, as usual, we have maintained our dividend of $2.10 on the first Monday of each calendar quarter, which we continue to maintain going forward too. In terms of the year to date, we have given you 3.03% return as compared to index, which has given almost half to 1% return. Again, a gross of performance as compared to the market at large. I'm sure most of you are familiar with this graphics. This is the first page of a weekly fact sheet where we share with you exactly the key specs of the portfolio. In that regard, as you know, our portfolio YTM is 5.42%, leverage YTM is 11.77%, duration of 1.8 years, and we have paid you close to almost $50 in terms of dividend life to date. In terms of top holdings, they continue to be among the biggest firms in the region or in the industry. We have Adaro, which you know is one of the largest coal producers. They have a EBITDA of almost 900 million, against which the debt is hardly about 167 million net. Silverdale continues to, again, among the top 10 holdings. Once again, we have given money to the Silverdale fund manager, not the fund. They manage more than $300 billion of assets. The amount of income they have is almost equal to the debt which they have outstanding there. Helsen Agri is the Singapore-based natural rubber supply chain manager, owned by Sinochem, again, a very strong company. BNP Paribas, the largest bank in France. Phoenix is the reinsurance company based in UK. They have almost 1.3 times of capital adequacy required. And as some of you noticed, about 3 days ago, they got upgraded because of their strong financials. Shyam Transport is the largest leased truck leasing company in India, again doing pretty very well in terms of collections. The collections pretty close to 90+%, which shows that there's no problem in terms of delinquency there. Far Eastern, again Chinese owned non-bank leasing company with assets of almost $45 billion, very robust company. Prospect Capital, third largest BDC company in the world. 80 securities, German-based warehouse and office holders. Blue Star is an exceptional pick by us given what happened with ChemChina. Blue Star is owned by ChemChina, and we gave a good opportunity to pick up the bonds thanks to the ex-president of US, which created rumors in the market. So just to summarize, in terms of the Q2, we have given you a return of almost zero. But the key point is that the return which you should be getting for Q2 is now been captured partly in terms of the leverage YTM, which being about 11.77%. Just to again point to you one important thing, and I'll cover in the next slide again. The yields continue to be elevated, which is absolutely exceptional, and I take that in a few seconds. Again, to re-emphasize, there's no change in this strategy. The yields elevated with low cost of borrowing gives you high potential returns. We have maintained our quarterly dividend of $2.10, which we anticipate to continue in the coming quarters. Talking about the yield, just to give you a flavor once again, the spread between US IG and Asian IG is currently at 51 bips. On average, it's typically around 30 to 32 bips, which means you are getting close to about 75% higher than what you would get for the risk you are taking. And as always, I'm pointing to you, at the spread of 133, we're talking about implied default rate of close to about 11%, which is mind-blowingly high because the actual default rate of IG for the year 1981 to 2019 is 0.88%. And for those who are worried about pandemic, which of course in the last legs, in terms of its immediate impact, let me take you to even the worst times, which was in 1930-33 with the Great Depression. At that point of time, the default rate of IG bond was 1.6%. And remember, there was no QE the way we saw at this time. So 11.8% is even lower than what typically we would see in a high yield. Talking about the high yield, the spread at 411 is almost crazy. It's crazy because the typical spread of US high yield and Asian high yield is 80 to 85 bips. Against 80, 85 bips of the normal spread, you're getting a spread of 411, almost 4 to 5 times higher spread, which is absolutely wonderful. To put it the other way around, the spread in US has come down, the spread in Asia has gone up, resulting in the spread between US high yield and Asia high yield to be at historic high. I want you to remember these words. This is a historic high. Such opportunities come rarely in life, so be careful about the opportunity which is on hand. To put it the other way around, at 684, we are talking about implied default rate of roughly about 46%. And you know, from your own commonsensical view, you're not seeing 1 in 2 companies getting defaulted. So the most important message which I want to re-emphasize today is the fact that the yields in Asia continue to be elevated. And in the Q&A, time permitting, we're happy to go more details into it, that why it's happening and why this is a great, great opportunity. For you as investors, is a doubly good news simply because of the fact that while the Asian yields continue to be elevated, the cost of borrowing, which is linked to the US LIBOR Fed overnight rates, is low. So it's a very rare time you get a situation where your yields are elevated, cost of borrowing is low, and therefore you can make relatively higher than the average returns you will make. And I'm sure some of you have seen this slide previously in terms of the fact that Fed has been successful in terms of increasing the market expectation into market neutral rate. And this is brilliant because this is the core reason for potential success of the Biden's $1 trillion infrastructure spend. Without the increase in the market neutral rate, it would have been impossible to attract the trillions of dollars which US wants to invest in terms of infrastructure upgrade. From the investor point of view, it's brilliant because it means that the portfolio yields have cheapened, which basically means where earlier they were at what you see in the yellow curve, at the end of last year, it became what you see in the blue curve. Now it is a gray curve, which basically means that the area which we want to focus on has moved from being much more steeper. This is very, very, very important because cheaper the yield curve, you can make more money riding down the duration curve, which basically means the active would start outperforming the passive. Proof, you see the amount of monies flowing into fixed income between active and passive strategies. You will notice a very, very clear visible signs of the smart money the big money now getting more allocation to active managers as compared to passive managers. So be on the alert. The point number 3 today for you to take away from the market perspective is the fact that because of the steepening of the curve, you can make more money riding under the duration curve. Therefore, the active strategies have a better chance over the passive strategies. The other interesting question is because of the fact that the market neutral rate is close to what FOMC wants market neutral to be, which means the yield curve are basically stabilized. Right? We are seeing the 10-year treasury to be with a very tight bracket. Right? And just to tick the box on people, those who are scared about the inflation, just to remind you, the inflation is of two types, the demand-led and the supply constrained. We are not seeing the world booming. And that's why the inflation is not because of demand increase, it's because of supply constraints. When there is supply constraints and if you increase the interest rate, you shall kill the companies. So the inflation we're talking is transitory. And of course, the important thing also is that all central banks are on the toes to make sure that things don't go haywire while the market readjusted with supply chains and supply constraints being reformulated. This can also be seen from the sharp drop in the velocity of money, which you have seen across the year, and finally leading to a very funny situation. The GDP of the country comes down and you see the person income going up. So takeaway to you is in terms of inflation, is it transitory? It gives you an opportunity to benefit from the market positioning, and in terms of, from that point of view, having a high yield in Asia, low cost of borrowing in the US is a fantastic news for you. With that, let me just conclude by sharing with you that we have given you a trailing 12 months return of 18.75% as against the index, which is given about 1.5% return. In terms of portfolio YTM, we're talking about 5.4% YTM with the cost of borrowing of about 1%, which means a fantastic YTM of 11.77%. Great news for those who want to add more. We would continue to be on our path in terms of being well diversified into high quality and short duration and benefit from what we see in terms of steepening of the curve across the time. During this whole period, we hope to be able to maintain our duration, our dividend of $2.10 which is paid typically on the first Monday of each calendar quarter. This shows our performance on a yearly basis. This is dashboard of our risk parameters. As you know, we monitor more than 50 parameters in terms of the risk. To summarize, we're talking about fund which typically gives you 7 to 8% return. We hope to be able to give you more than average return this year, given what we're seeing in terms of the yields by using prudential leverage. We have a track record of 0 defaults in our portfolio. We continue to maintain 5 to 10% unpriced credit limits, currently slightly on the higher side, and we will be deploying it suitably in coming few quarters. Continue to be high quality portfolio, paying you a dividend of $8.40 a year on year. As you all are familiar with the fungible cash flow model based on real cash of the company and not accounting cash. And we expect 15 to 20% upgrades every year. The first half of the year, we've already got 8 upgrades, very well on the path of a historic track record of getting upgrades. Just to remind you, these upgrades provide additional alpha to you, right? So it's very good news, and more importantly, it gives you assurance that we are doing a good job in terms of having a fungible cash flow model, which helps us to not only get this alpha, which is of course important, but importantly to help us to make sure that we don't enter into a potential default position. We also thank our partners, those who have been very supportive of us. As you know, we have been able to launch 4 funds in the current year itself. We're grateful to you for your confidence in us. These are some of the platforms and some of the analytics where we are covered with. We are happy to take any further questions on this.
Sanjay, let me kickstart the question session. If you could just shed some light on China, because we do have a fairly large exposure to China. There are skeptics out there who feel, China is still a bit of a black box. So, if there's something you can share with all of us.
Okay. There are apparently regulatory headwinds if people talk about. We believe that it's a very, very good news. It's a good news because China has been able to respond to what we see in the market very effectively in a short period of time. As you remember, the shadow banking was a huge issue in China a couple of years ago. And what the measures they've taken in less than 2 to 3 years, they've brought down the shadow banking by almost 80-85%. Again, shows the way how effective they are into it. What's happening in terms of the internet companies, again, fantastic news, right? What they talk in terms of and what they talk in DD, absolutely great companies, because remember, when you talk about a new industry, it's very difficult to establish what is considered a traditional market. And therefore, the antitrust becomes a huge issue. Right? What we're seeing very carefully and candidly in, for example, in terms of US, just because you are creating the market and you dominate the market, it doesn't mean there's not a market abuse. In that sense of word, China has been a fantastic job in terms of making sure that they put regulation in place and make a level playing field, whether you call yourself fintech company or you call them credit companies. So in both the cases, you have to maintain the capital adequacy, which is good news. Likewise, in terms of the construction company, the real estate, the property development companies, in all countries in the world, and for very important and valid reasons, property companies would have multiple SPVs. Right? So it's very important to make sure that when you are regulating the whole industry, they need to make sure that they are providing right sort of financials for you to regulate it. Therefore, China has come back in terms of the three red lines is brilliant. Just to remind you, Chinese property companies are among the best in the world in terms of disclosure, given the fact that they are the few companies they are among the few companies in the world which tells you on a month by month basis how much sales they do and importantly how much cash they have. Many of these companies also will share with you the bank account details. In terms of Hurong, it's something which I'm sure many of you would want to know more. I did cover it. I think it was on 16th April newsletter, but Mohin can give you exact date. Very broadly speaking, Hurong is the largest AMC in China. It's among the 4 AMCs created to clean up the banking sector in China in order to make it more capitalist oriented across out there. And they've done an incredibly good job. Except that they did such a good job that they have such a fantastic track record that the ex-chairman of Hurong did a lot of uncalled for non-code diversification, which was not looked upon favorably. And importantly, it was shown that in some of the cases, it was a clear case of corruption. And therefore, he was one of the rare CEO, or what do you like to call it, who was hanged in last 10 years. Which shows, again, China's decisiveness in terms of movement. If there is corruption, they want to act it, they will act and they will show it doesn't matter who the hell he is, which is again a good news. So what happened is that the crack team which was sent by the government in terms of taking care of the AMC, they did a fantastic job. Took 2 to 3 years to clean the whole balance sheet. As of December 2020, they came to a point where they need not make more provision till December 2020 for almost a couple of years. Whatever their profit they made, they used it to write off some of the uncalled for diversification, non-core diversification. Having done the job, next task obviously was that what next? Now that we have done the turnaround and things are getting back to track, and they told we need to reorganize the company, which was taken by the market to be called a quasi default. Long story short, the government, the regulator in particular, came and confirmed that no, wrong is good to go. They will meet the liabilities as they concur. The company has been given a couple of statements confirming that they will honor the commitment that they have, and very importantly, they have honored every single commitment in terms of outstanding, etc. So from the what they spoke and what they're doing is absolutely on track. 2 points. Point number one, would they go through structuring? Potentially, the answer is yes. And the reason is very important. Look, China has grown tremendously in the last 20 years. It's very important the AMC to have a large size and scale to be able to handle large companies. So it's only natural that they need to consolidate and rehash the whole structure. And also because point number two is that they've already declared that they will be hiving out some of the non-core entities, which are good entities. They're doing pretty well, but that's not the core to it, which they have already declared and they are already doing on the path for it. So in totality, we don't see any issue there. As I mentioned, 2 points. This first point, again, is of course the fact that Hurong is too big to fail, in the sense that, please remember, Hurong will be multiple times bigger than even Lehman Brothers in the US. Right? So it makes no sense for them to go for default when they have reasonably good assets in terms of what they're doing. So we do have stake in Hurong, which we have shared with you. We own Hurong Leasing and Hurong Jan 2022, almost half and half in both of them. Hurong Leasing is very close to par, you don't see any issue. The 22 bond, as you know, are in discount, and therefore it gives you a apparent feeling of crazy yields. I want to emphasize this point because I've got this same query from 2-3 stakeholders in the last 1 quarter. If a bond quotes at 99, and let's assume it's maturing in 1 day. Now I do know it should not quote 99, but let's assume for time being, and I'll clarify further. So if the bond's quoting at 99 is maturing in 1 day, forget everything else, we're talking about a YTM of almost 365%. So that is basically the crux of the thing, that what happens when a bond quotes a discount close to the market price. So you see a crazy amount of YTMs. I wouldn't get carried away with it in terms of the numbers sector out there. I would go the big picture sector out there. The point is that yes, the yields are elevated, but the risk we're taking, it's a good risk to take. There are 3 questions on that, so I think they can. So one question was, yes, your question that Hurong was downgraded. Yes, it was indeed downgraded because of that, and that's the reason. One of the reasons, which remember we talked about the tactical move, where the A moved to triple B, and that's one of the items there is indeed Hurong, not entirely Hurong. Just to again emphasize on it. The question is, from the history of our fund, is there a comparable scenario of current projected elevated yields and what it did do to our returns? The answer is yes. With whom yes is because it has not absolutely one-to-one correlation. But let me take you to the yield curve which I showed you earlier. So elevated yield typically would result into a higher return in the subsequent period. Okay, here it goes. This is to answer the question that, does elevated yield means high return for me? The answer is more or less yes. So let's look into a couple of points. For example, if you look in terms of the yields here, which are elevated here, and here yields here, which are on downside, right? So you see the higher yields in terms of returns, what they're talking about. Oops. So when you see a higher yield, typically you get a higher return on totality basis, and on the particular time when you be looking at it out there. So the key point is, yes, high yield would typically give you a high return minus defaults. And as you know, we have a track record of having 0 defaults in our portfolio. Hope that answers the question. Please feel free to add anything more you want me to elaborate there. Anything else you want me to clarify there? Thank you. You're welcome. So the more important thing to keep in mind is that such situations of elevated yields and low cost is very rare to have. Typically, when your cost of borrowing goes up, the yield goes up, cost of borrowing comes down, yield comes down, right? This is a very interesting time when you have elevated yield and low cost of borrowing. So please make the maximum you can make out of it. And let me again raise a flag to point out to you, this is in terms of Asia, not in terms of US. So the question is that can we make direct investment into Silverdale bond from UAE? Just to clarify to you, there is no restriction in terms of anybody from UAE to invest into the fund directly. Just to clarify to people, those who are not up the curve, especially UAE people. So in case of UAE, the fund can be a professional fund or retail fund, and there's certain requirements in case of a classic retail fund. But in our case, since we are MS regulated, we are regulated in the home jurisdiction. We have got the necessary license, the fund manager being licensed out there. In terms of any investor wanting to put directly money with us from UAE, that's not an issue.
Are there any further questions? We've cleared all the questions in the chat box, Sanjay.
I think all I've answered there. A couple of the repeated questions, but I don't see any other questions there. Would you be allocating more towards high yield in the next quarter to take advantage of high yield spread in Asia? I wish the answer was easy to give me yes or no, but well, I will say around. Our IG is 77%. As you know, our target is 75%. So we do have a headroom, and we do see good opportunities in our risk-adjusted basis. So with the broad living thinking, the answer is yes. Such exceptional opportunities come very rarely, and we do see some of very short duration high yield bonds giving fantastic return, which is something which maturing in a couple of months, giving you a good return. So there are potential things which you are looking into it, and you shall see as early in current week's fact sheet. The fund has exposure to countries other than Asia. What could be the effect on the yields going further? Well, of course, we are well diversified because being Asian bias fund, we typically, normal circumstances, have about 2/3 in Asia. I don't see the ratio changing significantly. Also because of the fact that roughly 63% of all issuance in emerging markets are from China, right? Now, a few important things to keep in mind. Number one, that the amount of issuances this year, 2021, are expected to come down for multiple reasons. One, of course, is the fact that that mad rush for cash, right? What I put in my CLA dash for cash of 2020 is already over. And many of the companies have realized they're sitting on more cash than actually required. Just become too conservative, right? See, Center, Phoenix being a couple of examples there in our portfolio. Number two is that if you look in terms of the maturity profile point of view, you would see that the requirement from China and Europe in terms of refinancing in the year 2021 is lower. So from that to a technical point of view, we don't see a diverge of issuances coming across in the market. So I don't see in even terms of ex-Asia, the yields, considerably coming down from here, from your point of view. So I would see like it's pretty flattish across out there. Yes, in terms of part of US specifically and part of Europe, we will see a small part of Europe. I should point out to you, we could see some unfavorable gyrations, and our exposure to that is minimal. Anything else you want me to address you? Thank you. You're welcome. Comparison with equity market. See, we always maintain that like we are not experts in equity market. I would just like to highlight this. Many of the equities have moved tremendously, have become overvalued. I would be careful in that sense of the word. I would just highlight two things there. Number one is the fact that in any portfolio, fixed income is a must, right? Both from diversification point of view, both from reducing the walls point of view, from the point of having some sort of steady income, something to fall back upon. So from those point of view, equity makes a lot of sense. And secondly, when you're comparing a leveraged equity, leveraged bond fund with equities on risk-adjusted basis, typically a leveraged bond portfolio gives you superior return as compared to equities. There would always be small times of unreasonableness or irrationality. But if you look in terms of the history of 130, 35 years available, you will see a leveraged bond portfolio gives you a superior return on risk weighted as compared to equities. Again, before I conclude it, to remind you, equities are very, very important role in the portfolio. So the takeaway to you is that it's very, very important to be well diversified and don't have a hubris. Very, very, very important. So human mind is such which has an anchoring problem. This is human nature. You can't help it. That's the way human body is created, and that's very important for you to be human. The problem with the anchoring bias is that you would always be over affected by what's happened recently. Right? That's the reason why when you go with people that are happy, you feel happy. You go with people sad, you go sad. Same thing here. Because of the excessive return you saw in equity market, only in select equity market, namely in terms of the internet graded companies, that's not the truth. That's not how equity is supposed to work. Give you 3, 4 times return in 1 year. So don't get carried away by recency bias. Be pragmatic, look medium to long term, and in that sense of the word, both equity and bonds have a position in a portfolio, and leverage bond portfolio gives you a superior risk-adjusted returns. Any other questions, please?
Sanjay, I don't see any further questions. So if you would like to just conclude.
Thank you once again. We are grateful to your confidence in Silverdale, and rest assured that we will continue to do what best we can at all circumstances. In particular, we would try to be ahead of the market in terms of understanding the gyrations and taking care of this. Make sure that you generate superior returns. As on data point of time, Silver Bond Fund continues to be focused on high quality, low duration, and importantly, has an elevated leverage return yield of 11.77%, which points towards potentially higher than the average return you typically see in the Silver Bond Fund. So thank you once again very, very much appreciated. Be safe as you always and be in touch. Thank you.
Thank you very much, everyone, for your time today. Thank you.